as now, not to be too threatening here, as everybody knows the story or has heard the saying, if you seek peace, prepare for war. And that was by a guy called Vergetius, who lived in about 390 AD, a long time ago. There was somebody else more recently, his name was, you may have heard of him, his name was Winston Spence Churchill. He said, it is important to understand that the United States is essentially a naval power. He said that in the first volume of his history of the Second World War. If we look at the current military position and the risks in the military positions in the Pacific, a good place to start is the statement of Admiral John Aquilino to the US Senate given in March last year. And I'll just read a couple of paragraphs from that, of the introductory part of that long presentation. We must recognise that the most dangerous national security challenges are evolving faster than our current government processes allow us to address them. Each of our three major state threats, the People's Republic of China, Russia, and the Democratic People's Republic of Korea, are taking unprecedented actions that challenge international norms and advance authoritarianism. These adversarial regimes are increasingly interconnected, which is evident in Xi and Putin's declaration of a no-limits friendship, as well as Kim Jong-un's material deliveries to Putin in support of the illegal invasion of the Ukraine. Nevertheless, China is the only country that has the capability, capacity, and intent to upend the international order. Even amidst slowing economic growth, China continues its aggressive military build-up, modernisation and coercive grey zone operations. All indications point to the People's Liberation Army meeting President Xi Jinping's directive to be ready to invade Taiwan by 2027. Further, the PLA's actions indicate their ability to meet Xi's preferred timeline to unify Taiwan with mainland China by force if directed. Now, the result of that and the ability of China to build ships more rapidly than the US has led to the introduction in the US Senate of a bipartisan bill on the 19th of December 2024 called the Ships for America Act. It opens with the comments in the legislation, what they call the morale of or the moral of the legislation, with the statement that strategic sea lift made up of government and commercial vessels is a critical capacity for executing the maritime defence strategy and wartime and peacetime economy of the United States. On March the 4th, only a few days ago, Trump said in a speech to the US Congress, amongst many other things he said, we will create a new Office of Shipbuilding in the White House and offer special tax incentives to bring this industry home to America. So in his first term, in Trump's first term, he attempted to rebuild the manufacturing in the US of steel and aluminium to support military construction. And in doing so, he put a 10% tariff on steel and aluminium. And the result of that, there was a significant lift in US production of both of those metals. Unfortunately, and it reminds me of a statement that Barack Obama once made, see Joe stuff it up. that during the Biden administration provided import waivers so that they could, the US could import steel and aluminium. The result of that was that domestic production fell, and the majority of the producers actually left the industry. So the result of that is, if you want to build up enough domestic production of steel and aluminium to base your shipbuilding industry on, what Trump has done in return, when he's returned, is generated a 20% tariff on steel and aluminium. So the point of that is to rebuild the shipping industry, and not for any other reasons that you may have heard on Australian media. And the reason for rebuilding the shipbuilding industry is so the US can defend our part of the Pacific as well as other parts of the Pacific. Looking forward to, or moving forward to our presentation, there is a rumour with the stock market falling that the US economy is going into recession, but the evidence simply doesn't show that to be the case. Last year, the US economy grew by 2.8%. This year, it is slowing, and the reason it's slowing down is because the Federal Reserve put up interest rates because inflation was too high, and now as inflation is declining, what you'll see is further cuts in the Fed funds rate, similar to what had been happening previously. So growth this year will slow to 2.3% and 2% next year. The euro area, on the other hand, grew at about 0.7% last year, and will grow at about 1.1% this year and 1.4% next year. Probably faster than that, because what you've seen is that now there's going to be far more domestic manufacturing in Europe. And so what we think is there'll be faster growth in Europe. And what you've seen the result of that, and we actually have a model of the process later in the presentation of what the result of that announcement is to lift German interest rates in particular relative to American interest rates, particularly at the long end of the yield curve for 10-year bonds. And this has led to a lift in the euro and a fall in the US dollar. Now, we think there's a lot more in that movement, a lot more downside move in the US dollar. And those who understand the commodity market, pretty much everybody in the room, knows that as the US dollar falls over the next year, that will generate high commodity prices. But I'll get to that later in our models. This is our model of Australian export prices of commodities. It's based on two things. One is variation in the US budget deficit, and the other one is the level of liquidity in the international monetary system to finance international trade, and this is called total international reserves. You can find this published by on the web and updated every month by or every quarter rather, by the International Monetary Fund. So we built a model based on this, and what the model tells us is that the rate of growth of international reserves for the last couple of years has been the lowest since the early 80s. And this has generated a slump in commodities, which you've all seen. But this rate of growth is now accelerating again, and I'll show you a couple of more slides of this in a minute. And as that happens, what you'll have is a recovery in commodity prices, world commodity prices, and a lift in the RBA index of export prices. So it's not so much it goes up dramatically, but it shifts up and then starts drifting up on a regular basis. So it's a sort of like an extended period of, much better than you expected times, and commodity prices significantly higher than they were, say, in 2015 or 2016 or 2017. And here we see, this is my projection of the increase in international reserves. Like I said, in 2022, there was a sharp fall in international reserves. So that generated a slump in world trade, which generated a fall in commodity prices. We've seen that. But now we've got that recovery happening in international reserves. We'll see commodity prices rise. And here is the rate of change of international reserves. And you can see again that the level or the rate of growth in 2022 was the lowest since about 1983. Quite a dramatic slump in the availability of world finance to support world trade, and that generated a slump in manufacturing trade, which generated a slump in commodities trade. Now that growth rate has accelerated to the long-term median of 7%. After being negative, it's gone back to a long-term median of 7%, and it should get back up to a long-term average of about 9.7%. So you'll have normal trade, more normal liquidity growth supporting growth of commodities in the international market. Now, this is in terms of our model of the US economy, which I'll walk you through. This is a broad index of activity in the US economy called the Chicago Fed National Activity Index. Okay, and it's been incredibly reliable for the last 30-some years that the Chicago Fed has been publishing it. Now, right now, remember what the Fed was trying to do. It was trying to slow growth in the US in order to allow inflation to fall, and it was successful in doing that. And so zero growth here, zero is the long-term trend of the US economy. So it was a 0.2 of a standard error below that level to generate below trend growth to generate enough space in the economy for inflation to fall, and that's what's happening. Now, we have a model of US growth based on that indicator, and what it tells us, and you can see it's a very reliable model going back to the beginning of this century, and it tells us we can expect growth in the US economy of about 2%, which is not as high as the last year when growth was 2.5%, but that's really continued solid growth, and you have solid growth and low inflation. So no, I'm sorry, the reports of the death of the US economy have been exaggerated. The problem that the US government has is the rising level of US debt. I think that in Australia, we allow our politicians to have original ideas as long as an American has thought of it first. And Joe Biden, he learned to spend a lot of money on a lot of different things to try and stay in office. And we have a Prime Minister, Albo, who's spending a lot of money on a lot of things to try and stay in office. But the problem about that is, in the US, the debt to GDP has been rising. And eventually it rises to a point where, as it's already risen to a point, where the amount of money that the US is spending rolling over its debt is higher than its military spending. And that's a dangerous position to be in. It's a dangerous position for, if you want to be able to defend an area as large as the Pacific and build a battle fleet. This is a discussion of mine, a chart that I show when I'm talking about the ability of the RBA to continue to cut rates. Because if I look at the last 20 years of data, or even the last 10 years of data, which is in this chart, it shows the relationship or the trade-off between inflation and unemployment. We've currently got unemployment in Australia of 4%. On average, that should allow us to have inflation of 3.7% now. It's lower than that now, but a lot of that is because of government subsidies kept knocking down prices, particularly power prices. I think that to maintain a consistent inflation level of 2.5%, you need a higher level of unemployment, that is to say 4.6%. So I think, based on this, that when you take away the subsidies that the government has got, particularly the power prices, it's really, really hard for the RBA to keep low inflation in this circumstance, and it's really hard for them to keep cutting interest rates. So I believe that there might be further rate cuts in the US, but I'm having difficulty believing, with a Prime Minister who spends money as freely as ours does, that you're going to have further rate cuts in Australia. Unemployment is 4% in the US, and that's down from 4.2% previously. Euro area growth model says it'll grow around about what the European Central Bank says, about 0.7. The yield curve used to be inverted in the US, we're putting down pressure on the economy. It's not anymore. But what's really driving it is the size of the budget deficit. Now, this is a corporate spread. This is really important to driving what's happening in the stock market. This is the difference between, if you've got a lot of liquidity, if you've got very rapid earnings growth, as we do in the US, and if you have, that means that corporate yields fall relative to government yields. So that means that the premium that corporations have to pay to raise debt falls to very low levels. Right now, it's between 1.4 and 1.6%, and that's the lowest since 1997. So there's a lot of liquidity in the market, and it's that liquidity which has been driving the market up, plus the fact that earnings have been good. But you get this very volatile market shooting up and down in stock market terms. Into the bulk metals, metallurgical coal has declined. That's the green slide here. Thermal coal is off, as we know, and iron ore is drifting sideways. And we have various models now of various metal commodities. Crude steel production has peaked in China in 2021, and it's sort of, and then it has a seasonal variation, but the seasonal peak has been falling year by year by year. And so the recent peak in 24 was followed by a lower peak in 25. And so it's sort of, it's come off and is drifting sideways. This is the level of iron ore inventories at port. And what's important, what drives the price, is the level of inventories at port relative to the amount of consumption. And how many weeks? Now, on average, if we look at this, the long-term median is that there's 5.7 weeks of stocks at port relative to consumption. And right now we're higher than that. And right now there's about 6.5 weeks of stocks at port. So that means that the price, our model will say that the price of iron ore should be lower. And right now our model says that the equilibrium level of iron ore is $102 a tonne, which is where the price actually is. So the model actually works in a situation where you've got a lot of stocks of at port. Oil, this is the level of stocks in the US. These are reported every week by the Energy Information Authority. It's always difficult. You live in a world in which you've got the International Energy Agency, and the acronym is just the same letters, but they swing around. You know, so after 2 drinks, I keep confusing the two. But the Energy Information Authority, and that tells you that stocks are lower than they were at the peak in 2020, but not as low as they were back in 2014. So that level of stocks plus the level of the US dollar compared to the US dollar index is what drives the oil price in our model. Plus the level of costs, honestly, costs lag. And so our model of Brent tells us the equilibrium price of Brent should be about $88 a barrel. And the equilibrium level of US oil should be $72 a barrel, which is higher than the Trump wants at $50 a barrel. And that the average real long-term price of oil this century is $87 a barrel. So it's likely that the oil price is going to be a lot healthier than Trump anticipates with a drill, baby, drill. I mean, I love it when he says it, but it's just, you know. There is a drift off this is our LNG model. LNG model is really interesting to be able to create a model like this. LNG is really, this is an electricity generation model or how electricity generation, what's left over in the gap in electricity generation generates the price of LNG. That's how this model works. So therefore what you'll find is its movements in the alternative sources of energy, which in turn provide LNG, because LNG is crucial right through the Pacific and even in Victoria for determining what the marginal cost of electricity is. And So it's the interaction of these two other huge markets, the oil market and the coal market, which generates the LNG price. And what it's doing is it's basically stabilising at about 12, 16 per to a million metric BTUs after coming off a much lower floor. Metals, copper. These are level copper stocks, and they're slightly higher than they were in 2022. What our model is actually telling us, there's a lot of precautionary buying of copper. That a lot of the bidding up of the copper price looks to be strategic by somebody taking a strategic interest in it. Maybe it's China, don't know. But the copper price, even though our model is actually quite high, the actual physical price of our model estimate is $7,450 a tonne. The actual physical price is higher, so that suggests to me somebody intervening in the market. That's not a market clearing exercise. It's about a standard error too high. Nickel, on the other hand, is slightly cheap, which people are really, moderately cheap actually, moderately undervalued, half a standard error too cheap, which is usually surprising for me, where people are usually surprised when I say that nickel is cheap. Zinc. Zinc is pretty much exactly fair value in terms of our models. It's 0.16 of the standard error below fair value, so it's near as damn exactly where it should be in terms of its commodity prices. Lead, very slightly overvalued, and 0.6 of the standard error too high. Gold. So other people are interested in gold. Now, this is the only gold model I've ever seen. That is to say, the only gold model I've ever seen anybody ever present is mine, because nobody else ever has it. But I'll just talk a little bit about it because I know there's some gold producers in the room. What's actually happening here is this is gold as a monetary asset. And what we've always known is that gold keeps its value in US dollar terms, okay? So that's, as the US CPI goes up, it goes up. And it reacts in two ways to the CPI. It reacts both to the rate of change of the CPI, but mostly it just relates to the level of the CPI, US CPI, okay? So it's really holds the purchasing power over long periods of time. There's a US economist called Barrow, B-A-R-R-O, and he did a work comparing the wages that were received by a rifleman in the US Army now, and compared to somebody working in the Legion of the Divine Augustus at around about 2,000 years ago. And he found that in gold terms, the person is paid almost exactly the same in terms of the salary in gold, an individual soldier. So the great thing about gold is it holds its value over long periods of time. Right now, it's higher than our model. But usually what we'll do when it reaches this kind of level, it'll do what it did in 2015 and build it a top for a long period of time before it rolls over. So extremely interesting model to look at. Silver is cheap because it always follows gold. Currencies, it's really the supply of US dollars through budgets versus to what the budget deficit is in the US and what the budget deficit in the Euro area, which is one influence on currencies, and the other one is the relative interest rate, not the short-term interest rates. We have short-term interest rate in the model. It's really the long-term interest rates. It's the 10-year bond yield. So on the 28th of February, this model suggested that the euro should be trading significantly higher than it was. It was trading 104. And it did exactly what it has done exactly what the model suggested already. Okay, it's lifted dramatically. Now, since that time, I've run this model again yesterday, and the euro should now go up again to about $1.20. So what you'll see is it'll go from $1.04, where it was a couple of weeks ago to $1.20 within a period of no more than 3 months. Now what that means is the US dollar is starting to fall, and that's the beginning, that provides the beginning of our basis for the rally in commodity prices that we've been talking about. US budget balance, I think the way Albo's going, that picture is going to be a very... I get this data from the International Monetary Fund on these budget balances, and I think that by the time the April update comes out, we're going to have a significantly bigger deficit showing as a result of Albo's work for the last 3 years. And what will be shown in terms of the future estimates for the Australian budget deficit. Commodity-based model of the Australian dollar, obviously says it should be a bit higher than it currently is. Interest rates, inflation targeting model of the Fed. Yeah, what you've basically got here is a model which says that the Fed has got room to cut rates, but the RBA doesn't. Simple as that. And that's because, the Fed has been tightening policy for a long time. The level of rates in the US was significantly higher than the rates here. And tragically for the RBA, there's no such thing as a free lunch. Really hard to get, I won't do the Euro area interest rates, really hard to get, as I say, further rate cuts will be hard to justify in Australia. Do the Chinese hold all of the US bonds? And if they come in one day and they sell all those bonds, it'll destroy the US Treasury market, okay? Now, people believe that. People believe that. And that was true up until about, 2013, okay? But what's happened since 2013 is the Chinese aggressively started selling all of those US bonds that they held. When back, like I say, in 2013, they were the biggest holder of US Treasury bonds in the world, and now they're not. And what's really interesting is we've got this list of countries which show that, in fact, Japan is now the biggest holder of US Treasuries, and the UK is the next. Now, why would the UK hold US Treasuries? Well, the UK has the biggest international banking sector in the world. I've often said about Britain that the UK is a banking system with a country attached. It's a UK banking system which generates most of the international value and the exports of services for the UK economy. And I've been doing that in terms of the international economy in that way, the US market, since about the 1960s at least. It's not that the UK government is holding this, that the UK banking system is holding this on behalf of a whole range of international investors wherever they live. So after that, after the UK, so that you've got Japan, then you've got the UK, and then you've got a whole lot of smaller countries like Luxembourg, Canada because its interaction of its banks with the US banking system, they hold a lot of bonds. The Cayman Islands hold, obviously there's huge industry in the Cayman Islands, big manufacturing plants and all of that kind of stuff. So obviously they're holding it from a whole range of people in different places that may remain nameless. And then a lot of other smaller countries and places like Luxembourg and such hold US Treasuries. So no, it's not true that the Chinese hold all the bonds and they can come in and destroy the US Treasury market. They sold them all years ago.